So I'll say good afternoon again. This is Joe Pantozzi with Alpha Omega Wealth. And today is an introduction to private banking. Now, when I say introduction, what I'm primarily going to be talking about today are the basic foundational principles that we build upon. So today is not a book review because there are going to be some people, hopefully a lot of people on this call who have not read Nelson Nash's book. And so we're not going to make you answer questions from a book that you haven't read yet, but we're going to strongly encourage you and invite you to read the book and let us know if you need information about how to get it. You can go to Amazon and order Nelson Nash's book, Becoming Your Own Banker, The Infinite Banking Concept. And we'll be referring to a couple of other of his books. So How Privatized Banking Really Works, his book written by Nelson Nash and Carlos Lara and Robert Murphy. And a really excellent book is called The Case for IBC. This is a must read for business owners. The first chapter of that book talks about the business cycle. We've had a bunch of meetings and webinars and seminars with clients talking about the business cycle and how to address the issues and problems that come up when you're going through the business cycle and you have ups and downs in the economy, you have ups and downs in your business, you have different seasons where some people are buying more during a season, some people are buying less during a different season, and how to address those needs that come up, the role that banks play in those business cycles, the role that your infinite banking concept plays in those business cycles. And then, of course, Nelson Nash's fundamental foundational book, which is been published 20 years ago, October. So October 2020 is the 20th year of his coming out with this book. So we're going to get started. Yeah. So I want to mention a thing about privacy. So I know that there are a bunch of people logged on, and we do have a private listing of the people who are logged in. We are not showing your names to each other. So those of you who are attendees today don't know the names or the identities of the people who are on the call, and you won't see each other's faces. So we're keeping that element or that level of privacy. We're not sharing this mailing list with anybody. The only thing that we'll do is thank you and follow up with information that you'll need, references to websites, to blog posts, to podcasts, to books, to white papers. And all the information that you'll ask for, we'll share with you on a one-on-one basis, and there will be no sharing of any information. So I think we've addressed the privacy issue. I want to give a shout out to my adopted dad in the business, Nelson Nash. I actually met Nelson Nash in 2001, almost immediately after the book came out. And he spoke at a seminar in San Clemente, California. And a friend of mine invited me to go down to San Clemente, and I'm sure there were no more than 16 or 18 people in the room. And Nelson did his 10-hour seminar over a 2-day period. And we learned the basics of the infinite banking concept. And over the next 19 years, Nelson continued to teach that 10-hour seminar. And I'm going to say he did not change hardly a word. He didn't hardly change a joke. He didn't hardly change a personal story. And I do have the 10-hour seminar on video that our advisors can avail themselves of. But it's great to have that as a memento and as a permanent reminder of who Nelson was and what he did for us. Now, from my perspective, I was a quote-unquote professional in insurance and investments when I met Nelson. And I was doing this for 25 years before I met him. So now I'm in approximately my 44th year. I'll finish up my 44th year in October. And I got to tell you that I believe Nelson has done more for the financial insurance investment industry than any one individual that I've met in the past 20 years. He was a great man. He was a loving man, loved his family, his kids, his grandkids, his great grandkids, and he was nothing but gracious and generous to us, his adopted sons, many of us. So it's been my desire and my mission to share with everyone that I could come across what Nelson taught to me and what Nelson shared with me. I don't think we could hardly have a discussion of any kind today unless we're talking about COVID. It seems like we have a discussion about COVID 50 times a day. And it's a matter of, am I taking a drug to prevent it? Am I getting tested? Am I going in the hospital? Does my family have a vulnerability to it? Who do I know who has a weakness? There were all kinds of stories. We had a client whose father died on April 2nd, and we were under the impression that he had passed from COVID. And because he died in New Jersey, which is a hotbed of COVID contagion, it took a really long time. It literally took almost 4 months to get a death certificate. And we found out that he actually died from a heart condition, an undisclosed, unknown heart condition. So a lot of different things are going on because of COVID. Most of all what's happening to me is I've got clients, friends, non-clients, prospective clients maybe, contacting me with all sorts of questions about how to deal with their finances. Now, there's also some groups who are bringing up the topics that you see on the screen. Should we take COVID seriously? What about the economic disaster that's going on right now? Las Vegas had an unemployment rate that was above 30% a few months ago. Now we're just below 30%. We're still suffering the highest unemployment rate in the country, ahead of Detroit, which has a pretty bad rate itself. And then there are people who are concerned about the government being too strong and too onerous in terms of telling people what to do, whether they should wear a mask, not wear a mask, whether they can congregate in churches above 50, opening hotels, closing restaurants, closing movie theaters. There are a lot of moving parts going on, but we're probably concerned about all those things. Now, as I am a financial advisor, yes, but I'm also a person, and I care about the people around me, the people that I'm in touch with, and I am open for any discussion, any conversation about any topic concerning finance, concerning family, concerning business, concerning posterity, concerning COVID. So anytime you want to reach out to me, I'm happy to have information without exclusion. This is what I keep on coming back to. Rule number one is cash is king. Now, for I don't know how many years, we've been telling clients, you really should have 3 to 6 months worth of cash reserves available that you can get your hands on. Well, I don't know how many people in this country actually have cash reserves for 3 to 6 months. I know I do. I know I have a lot more than 3 to 6 months of cash reserves. And maybe it's because I've taken my own advice seriously for a long period of time. But there are also a lot of people who are coming to the realization that 3 to 6 months is not necessarily the best advice. Maybe 3 to 6 months is good in good times when most people are working, when most businesses are open. But now folks are coming to us and asking all the questions that you see on the screen and even more. So they're asking about refis. I've heard some people refiing their house. Some people are taking early withdrawals from their 401k plan. Some people are taking 72T withdrawals from their 401k or through their IRA. Some business owners are getting involved in a paycheck protection program loan or a PPP loan. some business owners are getting involved with the EIDL loan, the economic injury disaster loan. And they're having to get the details on how to apply, how to keep up with their application, which is digital through the government's websites and so forth. There's a lot of moving parts here. There are a lot of discussions, a lot of questions. And sometimes when an employee is employed at some business that might have 10 employees or 50,000 employees, they don't always know the right person to go to. It might be HR or it might not be HR. It might be an outside administrator. And if you have a question like that, I don't care if you're my client or not. If you have a question, just reach out and we'll direct you to the right party. And if we don't have the answer off the top of our heads, we will find out the answer for you, or at least put you on a course to get the answer. Let's talk about this new economy. I was just checking with the chief investment officer of one of our main life insurance companies yesterday, who told me that the government money rate is literally 58 basis points. So it's just under 0.6%. Now, banks will add their profit fee on top of that. So the current prime rate is just over 3%. 10 years or 20 years ago, 30 years ago, I'm sorry, the prime rate was 10%. So things are changing. The environment's changing. The demographics of the country are changing. 30 years ago, we had 45 million people over the age of 55. Today, we have 95 million boomers. We have life expectancies increasing. We have top marginal tax brackets increasing. We have a national debt that I would think many, many people are saying is totally out of control. So before we go down that path a little bit further, let's look at a family, an American family that's making $40,000 of total income. This family has $51,000 of expenses that they're paying payments on. And their total indebtedness is $265,000. So I'm going to ask this question as a theoretical question. I don't need you to get back on the chat room and throw the question out, but you could probably imagine that there are going to be some people who would give the advice that the first thing you should think about is bankruptcy. Maybe you should sell your house. Maybe you should move into a double wide. Maybe you should move into a single bedroom studio with your 4 kids and just cut off everything. Cut off the cable. Shut your iPhones off. Sell your couple of cars and go down to 1 car. Do whatever you can to stop the bleeding. Well, I put that family budget in the perspective of an individual family, but what I'm really talking about here is adding 8 more zeros. So this income is literally $4.5 trillion. This family has $5.1 trillion of recurring expenses, and this family owes $26 trillion right now. And you know, and you probably knew this several touches ago, that this is the United States. This is us. We are the government. So this is our national budget. We're in some hot water right now. So let's go to fun fin facts. Question number 1. So we're going to offer 3 of these during the course of the conversation, and you're going to have the opportunity to answer a question. And I think that question is going to come up on your screen.
So go ahead and answer.
And if it doesn't come up on your screen, is that coming up on the screen that they're watching? You sure?
They're answering.
Oh, cool. This is new for me. It's fun. So when the federal government's expenditures for a year are greater than its revenue for that year, the difference is known as a budget deficit. I'm sorry.
The national debt.
It's far away. The national debt a budget deficit, a budget surplus, or you don't know. So we're going to take just a few seconds. And it looks like a budget deficit is what you all agreed. When its expenditures are greater than its revenue. So we have a budget deficit. It looks like 100% of you got that question right. So that means that I'm asking two easy questions. So we'll see if we can make them a little bit tougher as we go forward. See if you can advance me. And I'm always surprised that when I come across people who have never seen this debt clock. You can go to usdebtclock.org, and what we did was just took a snapshot of a point in time. So there are a couple of things I want to point out to you. So the U.S. debt that I mentioned is at $26 trillion. Just a few months ago, that was $24 trillion. Now, that's only the debt that we have today, and it's basically made up of taking the revenues that come in, and this worth of revenue, and then the actual spending is projected to be $6 trillion. And if you take some time and study this U.S. debt clock, I think you'll find some things that are pretty interesting. You'll find out that the personal debt per citizen is $62,000. There's $948 billion worth of credit card debt in the country. And there's also a big number down here, which hardly anybody talks about. $154 trillion is all the money that our government is going to need to make in payments going out in the future. So that's all the Social Security payments, all the retirees from various defense budget, federal employees, Medicare, Medicaid, welfare payments, $153 trillion. So that brings us to a discussion of the marginal tax rate, because you know that the government doesn't have any source of income other than taxes. So look here in the mid 1950s, the tax rate was literally at 90%. So there was a famous story about John Wayne, and he would make $1 million per movie in the 1950s, and he would work a certain amount of time, and then he would just quit for the year because he knew that 90% of his money was going to the government. Now, in the current period that we're in, we're just under 40%. Now, as you watch the national debt clock increasing, what do you think has to happen to taxes? And I know that people who sell a great deal of retirement plans, IRAs, 401ks, pension plans, profit sharing plans, SEPs, they're going to encourage you that you should put your money into accounts where you'll be able to defer your taxes to the future. And their premise is that you will be in a lower tax bracket in the future. So based on the fact that we've got a 4 or 5 month COVID situation going on where the government is going into debt in the trillions of dollars, based on the fact that we're going to have less income coming into the federal government and the states, we're going to have states not able to meet their budgets, the federal government not able to meet its budget because its income will actually shrink when people make less money. It's a domino effect, isn't it? So taxes must go up. And you may or may not know this name. David Walker was the Comptroller General of the United States for roughly 9 years under President Bush and Clinton. And he said, it's very simple. Taxes have to go up for one word. The word is 4 letters. It's called math. There's no way that we can continue on the present course without having to create an additional stream of income. So that leads me to a conversation about where you store your money. And it may not be the best solution to put all of your money into a deferred account where you're going to defer your taxes, because we've done the math and we know that taxes are likely to go up. I know that your income is likely to go up because most people make more money at the end of their career than they make in the beginning. So the first bucket is savings accounts, money market accounts, CDs, non-qualified or taxable accounts that are taxed today. We have money that comes into our hands where we pay tax today. And then there are these deferred accounts where we're going to pay taxes tomorrow. So 401ks, IRAs, etc. You just put that somewhere else, thanks. Then the third category is a place where a lot of people don't spend a lot of time in, and that is, where can I put money where it won't be taxed ever? Now, do you think the government has the ability to change the tax environment that we're in? Of course they do. But for right now and for a long time, people have been able to stash money where nobody can see it. And of course, I don't necessarily know that keeping money in a safe is a good thing. But I do know that people put money in the Roth IRA, which makes a little bit of sense. But the issue with me and with a lot of our clients is that most of our clients make too much money to qualify to put money in a Roth IRA. There are some circumstances under which you can convert from a regular IRA to a Roth IRA. We can talk about those where people put money to have it taxed never is a specially designed life insurance policy. Now, what I've come across in working with high net worth clients and larger companies is that very few people who are at the higher end of finance, who are at the higher end of wealth accumulation, who have high net worths, very few of those people are building wealth without using life insurance. So here's a disclaimer. I'm happy to send this to you, but life insurance values are based on the long-term claims paying ability of the insurance company. And that's no secret. And there are different places where you can put your money in where you'd have different guarantees. For example, FDIC applies to savings accounts. And we'll just talk about that very, very briefly. But FDIC is an insurance type policy where the federal agency has about 1% of all the money that goes into savings. So it may not be the best thing to just hang your entire future on whether or not FDIC will be there. One area where we spend a lot of time with our clients talking about is in the area of distinguishing between saving and investing. And I'd say a lot of people aren't really clear about that. So saving money just to pile it up and throw it into an investment is not what we're talking about when we mean savings. We mean saving money that's going to be in long-term cash or cash available liquid accounts where you can get to it. It's not just saving money so that you could throw it into the next great deal or the next great stock tip, or as a friend of mine says, I know a guy. And I've come across people over the past years and decades where somebody knows a guy who has a great investment opportunity and they wind up giving that guy their entire life savings. And you can imagine what happens. It's not always the Bernie Madoffs of the world that rip people off. Sometimes it's the guy down the street, deal maker, as a businessman, as an entrepreneur. And because people become familiar with who he is or who she is, they feel that I can trust this person at some point, and I'm going to take a shot and give him $50,000 or $100,000, and it doesn't always work out. So let's talk about different types of investment or financial vehicles. And I've just put 6 qualities on the screen here as qualities that I think the average person would want to have if they were going to design the ideal savings tool. So starting at the top and going clockwise, competitive rate of return. You'd want to have a return that's decent. You'd want to have some kind of a guarantee that's built in. You'd want to be able to make sure that your money doesn't go backwards, or it maybe doesn't get subject to the volatility of the stock market. When we talk about liquidity, we're talking about money that you can get your hands on within a week or so. We don't want to have to wait a month or 2 or 6 months to get our hands on money. We don't want to put all of our money, for example, into you can't get your money back out unless you sell the real estate, and that could take years. There was a very popular case of a local bank here in Las Vegas years ago, in this century, that went under because they made a habit of lending lots and lots of money on raw land. The feds came in and noticed that they were too high on their loan to value ratio, and that bank was taken over and eventually liquidated. So you do need to look at the ability of your investment or your financial account to provide liquidity or cash to you. It would be great if your ideal savings tool were tax-free. So let's look at 401k or IRA. So with regard to those 6 qualities, we'd say that we only have 2 of them. We might get a competitive rate of return, which might be good in some years, and it might be negative in some years. But that is what people understand is going to happen in the stock market. I'm an investment advisor, so we do have clients with money in the stock market, and that's a separate discussion, and those are separate accounts. We don't mix our savings with our investment, our safe money, with money that we're willing to take a certain amount of risk with. So with the 401k and IRA, you might get a competitive rate of return, and you'll have some credit protection. But the other 4 elements really would not be present. What about a savings account? I'd say that in a savings account, you'd have a certain amount of guarantee. Now, your interest rate that is going to be declared by the bank from year to year is not going to be guaranteed as to the future rate. But your savings account is typically guaranteed that it won't go down from year to year. So once they give you the interest, they're not going to be able to take it back. And then secondly, a savings account will have liquidity. We're going to be talking about Bauer Financial. Now, Bauer Financial is a company that analyzes, as you can see on the screen, analyzes banks and credit unions very carefully. We're going to be looking at the Bank of America report, not for that we're going to be using 2019 numbers. And this is a conversation about how banking works and how money works. And of course, our foundational book is the Infinite Banking Concept. So Nelson wanted us to learn something about banks that can be transferred over into our personal lives, and that's what we'll talk about. So we start off with a saver. A saver takes some money and brings it down to a bank. And this could be any bank. In this case, we're talking about Bank of America as an example. So Bank of America is the banker. Now, Bank of America will take our money and lend it back to borrowers. Now, you and I both know that we usually wear both hats at the same time, or maybe this 2 hats in the same week or the same month. And it's important for you to understand that once you go down to the bank and make a deposit, that bank legally owns your money. You no longer have ownership of that money. What you actually have is an unsecured creditor position against that money. It might be for the Bank of America went over $1 trillion, and that is $1 trillion. It's not $1 billion, and it takes me a while to look at the math of that in a second. Now, Bank of America then takes that money and repackages it and lends it back to us in credit cards and car loans and lines of credit. So Nelson said that we finance everything we buy. We finance everything we buy. We either pay interest to somebody else, or we give up the cash. We give up the interest we could have earned by paying cash. So when we talk about velocity, that's what banks are doing. Banks are creating velocity by taking our money in and keeping it moving. The problem is what we've been taught over our entire lifetime is that we should be on interest. Compound interest requires you to have your money sitting in some account. But if your money is sitting in some account, it can't be used in a dynamic way. For example, buying rental real estate. Now, Robert Kiyosaki has taught us a lot about rental real estate and the fact that we should be putting our money into capital assets that'll then create cash flows. And we could use those cash flows to buy the things that we want in our lives. So we can use those cash flows to pay for our liabilities, i.e. our cars, our vacations, etc. So let's look at a practical example. This is important because there is some misinformation, and I know you're not even going to believe this. You're probably not going to believe that there's misinformation coming out of Wall Street. But let's look at an example. And what I just suggested on the screen was, would you be happy with a 25% rate of return? So in order to do that, we're going to earn 100% rate of return in year number 1. We're going to lose 50% year number 2. We're going to make 100% again year number 3, lose 50% in year number 4. Now that gave us an average rate of return of 25%. And actually, this is legal for an investment company to advertise that their rate of return was 25% if they literally had this experience. Now let's put the dollars into this calculator and see what happened. We started with $1,000 and we made 100% profit. We wound up with $2,000. In year number 2, we had a 50% loss. We went back to $1,000. In year number 3, we doubled to $2,000. In year number 4, we had a 50% loss and we wound up at $1,000. Our ending balance is $1,000. Our beginning balance was $1,000. How in the world could we have had a 25% rate of return? Well, it's because we're talking about adding up a pile of numbers, dividing by 4 and giving ourselves an average. Now, for some reason, the federal government has allowed investment companies to advertise that that was a 25% rate of return. So let's go to fun fin fact question number 2.
Can you hold this 1 second?
Yep.
Some of the people want you to go back to the Bank of America slide. Because only half of it went through before the Wi-Fi went out.
Okay.
So maybe we can finish really quick. Did not see what borrowers are paying.
Okay. Okay. So we put $1 trillion in Bank of America's hands. Bank of America paid us $9 billion, which wound up being 88/100ths of 1%. And we paid them $60 billion, just under $60 billion. So we paid them 5.8%, which wound up being over 6 times what they paid us. Now, the idea is they're supposed to exist for the benefit of the customer. That's probably an old, antiquated, out of style saying, but usually when you're in a business, the first order of business is to take care of the customer. And what we can see here is that Bank of America is taking care of its shareholders, but not necessarily taking care of the customer in a big way. So we're going to move past the rate of the 25% rate of return and go to our fun fin fact question. So the question is, when we go to question number 2, what do you think the average stock market investor earned in the last 20 years? Your choices are 11%, 9.5%, 4.5%, 2.1%. Looks like a lot of you like the lower numbers. In a second, I'm going to show you the actual history of what the market did. We good? So the most popular number was, there was a tie. 40% of you said 2.1% and 40% of you said 4.5%. So we'll close that out. So here, use the richest of all the measures, which is the Standard & Poor's 500, with dividends reinvested. And as you can see here, from 2000 to 2019 inclusive, that's 20 years. And it says here that our average rate of return was 6.39. Now you know a little bit of the trick, if you want to call it that, of averaging numbers, which is what we're looking at here. So let's see how those apply. So I took those numbers, I added 2019, so now we actually have 20 years when you throw in the year 2000. 20 years, it's not 6.39%, but it's 7.22% with an average rate of return. Now, oddly enough, you see an actual rate of return of 0 here, and that is because there's no money on the screen. All we did here was we piled up 20 years worth of return numbers, and we divided by 20 to give ourselves a 7.22 rate of return. Now let's add some money to the screen. I've added $1 million as a starting balance. And you see that an actual rate of return shows up, but look at that. It's about 1.5% different. And it really doesn't make a difference to me whether it was 0.1% or 1% or 1.5%. The fact is, what we just learned is that averaging numbers is not the same as averaging returns on dollars. Okay, so your average return was 7.2 off the numbers only, and 5.69 when you saw the dollars. So now that's not the entire story, because unless you decide to be a day trader and lose 95% of your money 95% of the time. But when you use a professional investment manager, your returns are hopefully going to be more attractive. But what we did here was we took 1.5% for all fees, the broker's fee, the investment, broker-dealer's fees, administration, etc. 1.5% to reduce your actual return to 4.1%, which is what 40% of you thought would have been the real return for the past 20 years. But there's one more step, because if this is a taxable account, and I think if you're going to be in a stock market account, you should probably be in a taxable account most of the time. If we add that tax bracket in, and what I did here was I gave you a blended tax bracket of 21%. And that's going to embrace not only some you held a particular position, but it's also going to include some capital gains for positions that you held for longer than a year. So a blended rate of 21% gave you an actual return of 2.23. So when you see what the actual rates were, it becomes more important that you actually have a design, have a methodology, have an investment policy statement that you create along with your investment advisor. And this discussion today is not for me to solicit your account. I'm just talking about the way numbers work in the market, in the stock market, compared to the way they work in other areas. Now, I don't really like to rub salt in the wound, but I'm going to, just for the purposes of this discussion, and say, if we were to factor in inflation of 3%, after inflation, you lost money, because you started with $1 million, and after inflation, you wound up with $861,000. So you would absolutely want to do something different than this. If you know that inflation is going to affect everything that we do in our life, you want to have a strategy that is at least going to stay ahead of inflation. Let's talk about how we buy things, because I think there's a lot of misinformation about that. This is probably the most popular way that Americans spend their money, make investments, pay for expenses, is that we go into debt. We use a credit card, we take a car loan, we take a mortgage on a house, we go into debt to go into business. So we borrow money, we pay it back. We borrow money, we pay it back. Over time, we actually dig a deeper and deeper hole for ourselves because the creditor, the lender, the bank, the finance company knows that we've created a good track record. The better our FICO score goes up, the more money we get to borrow. Isn't that great? Then the other philosophy is, well, don't use debt. Don't use credit. Just save up the money that you need to buy the thing that you want to buy. And when you have that sufficient amount of money, go and buy the thing. The problem here, as you can see with these yellow dots, is every time we use that process, we're taking ourselves right back to zero. The creditor had to work to get up to zero, but the saver is spending all the money that they saved up to buy the thing, and then they're going down to zero. But there is a better way, because there is something called a wealth creator. So what the wealth creator does is not go back to zero. We talked about uninterrupted compounding, and this is what you want to have. You want to have capital assets that are going to appreciate even when you borrow against them and collateralize them, take loans for the things that you need in your life. So here's an example. A market account. If some of you are familiar with market accounts, you'll know that you could set up what's called a margin. You can set up a loan against your market account. Your market account will continue to grow, hopefully. And you can set up a margin account and borrow from the broker-dealer for the things that you need in your life. It might be an attractive rate. It might be 3, 4, 5%. But a couple of things happen. Number one, if and as markets do contract once in a while. We saw in the last 20 years, we've had 5 down years. We've had 15 up years and 5 down years. So when the market contracts and your account value goes down, your broker is going to call you up and say, you know, I need you to send me some money to pay your margin loan down because we need to keep a proper relationship and your market account. So that's called loan to value, just like you have on your house mortgage. Your house mortgage really shouldn't be more than. So there's variable. It's probably still better than doing nothing. But another example is using your house, and most people are familiar with this. When you have a house, hopefully your house is going to appreciate. And you've got a mortgage that is not going to appreciate with your mortgage value, with your house value. Your house is hopefully going to go up, and your mortgage value is going to go down because you're going to pay it down. So having a mortgage against the house does not restrict the house from appreciating. So that's a good thing. Again, you could have a situation where you go underwater, like a lot of people have in the past. Your house market value goes down, but your mortgage is higher than it. So you got to wait until you pay some of that mortgage down. Or some people will do short sale. They'll sell the house upside down, and they'll either give the house to the bank, or they'll pay the deficit, or they'll take a hit on their credit. The other way to borrow against the capital asset is to use a life insurance policy. Now, a life insurance policy is going to grow regardless of whether we have a loan against it, which makes it a very attractive tool to borrow against. It's a safe savings. It's not correlated to the market, as we talked about earlier. And we're going to talk about some people who used their life insurance. And I think some of you know these stories, or some of these stories anyway. Ray Kroc did not invent McDonald's. Ray Kroc actually bought into McDonald's, and he went into business with the McDonald's brothers, who had a different point of view about business than he did. They actually didn't want to grow the company and make it a worldwide enterprise, and he did. So eventually he bought them out, and during the course of time, he needed additional operating capital and borrowed against his life insurance to pay salaries, etc. Another example is Walt Disney. And he provided some of the financing to start Disneyland by borrowing against his life insurance. And there are dozens of examples like this. Another one is J.C. Penney. And I know that J.C. Penney has been on hard times, but I think they lasted pretty close to 100 years, which is not a bad run for a company. So again, he collateralized his life insurance. He went to the insurance company, took a loan against the life insurance, and the life insurance continued growing. And finally, Doris Christopher. She borrowed against her life insurance, took a loan, and started Pamper Chef. So we're going to go to fun fact. Question number 3. This is the last one, and I hope we don't have any glitches on dealing with this question. So let's see question number 3. I kind of like this one. What percentage of life insurance cash values do you think life insurance companies have loaned out? And let's just say lately. Now, I'm thinking about the COVID situation. I'm thinking about periods of time when people lose their jobs, get laid off, get furloughed, where businesses close indefinitely because of COVID. I think about 2001, where there's a market decline, 2008, where there's a market decline. And we've got about 30 seconds running. It seems like a lot of you feel that 18% is a good number.
1 more second.
Okay. And again, it just so happens I was on a call yesterday with the chief investment officer of a major company that we deal with, our number one carrier, who have $38 billion in assets under management. That means their entire balance sheet consists of $38 billion. Their life insurance portfolio is $14 billion. So that means they have $14 billion. Can I move forward?
Yes. Well, here's the results if you want to share that.
Oh, great. So 50% of you felt that life insurance companies have 25% loaned out. And 15% of you felt that life insurance companies have 42%.
No, 42% of them.
Oh, the opposite.
Yeah.
Oh, I'm sorry. 42% felt that life insurance companies have 15% of their reserves loaned out. So that was the number one most popular answer. I'm sorry. And 25% of you actually got it right. Because in most cases, all the major mutual companies that we deal with have less than 10% of their cash values lent out. Now, that kind of surprises me, especially during the period of time that we're in. So people have their policies. 95% are not borrowed against. That means, well, it could mean a few different things. One is those people have other reserves that they're able to tap into, and they don't need to tap into their life insurance reserves. That's a good thing. Are we good to move forward? Now, the infinite banking concept is one that, above all, is very, very flexible. And I want to put all 3 of these uses on the screen. There are probably going to be dozens of uses of life insurance, and we're not going to be able to go into those dozens today, but I wanted to mention to you just 3 of the things that I could think of off the top of my head. One is using the cash values and accessing them by loan or by withdrawal of dividends, by surrender of dividends, et cetera. A lot of different ways where you can access values inside a life insurance policy. But one use is to use it as an emergency fund. Another use is to pay down debt. We call that recapturing debt, taking a balance away from a finance company or a bank and taking it in-house. So making that debt part of the Pantozzi Family Fund or Pantozzi Family Bank. And instead of paying the outside mortgage company or lender that interest, I'm going to pay some of that interest to the insurance company, which is going to give me a loan on a more favorable basis than the outside lender. The outside lender might be requiring an amortized loan. A life insurance loan is always going to be an interest-only loan. I think that's a great attribute, which I think we may have misspoke here. Number 3, wealth to pass to the next generation. Now, here's an example that does come up from time to time, and I have this in red. I want to emphasize this in multiple ways and multiple times. I'm giving you an example here that's not apples to apples, but where we can help a client address a short-term cash shortage. So I've got 3 debts here that a client has, and this is a hypothetical client, but it represents lots of clients that I've sat down and worked with. So this client had 3 debts in this case: a $15,000 credit card at 16%, a $30,000 car loan at 7%, a $10,000 other loan at 8%. Their total payment was $1,000 a month. I'm just picking up my color here. Total payment was $1,000 a month under ordinary circumstances. Now, because this was an emergency, what I'm saying to the client, this is not an apples to apples comparison, but if you had that kind of money where you had $15,000, $45,000, $55,000 in your life insurance policy that you could borrow against, number one, you could do a lot better with a 5% life insurance policy loan than some of the numbers you're seeing on the screen. And we can make this interest-only loan payment of $229 a month. Now, this is temporary. This is until you figure out a way to start attacking the debt. But this is indefinite, meaning the insurance company is going to come back at you a year from now and say, okay, it's time to start paying the principal down. They will never come back to you and ask you to make a principal repayment. I think that's a tremendous difference and a tremendous advantage. I'm not going to spend a lot of time on graphs and charts, but I really thought this was important. So we have a pre-Nelson situation here, and you know that I was placing life insurance for clients for 25 years before I met Nelson Nash, and I would sell a policy that looks like this. Client comes in and says, well, I've got a budget of $20,000 per year to buy life insurance. The client's 40 years old, and we're going to set up a policy that's about $1 million, $1.5 million. Now, this was a very well-designed policy for what I knew at the time. These policies are still in effect today. In fact, I own some of these policies that I designed back in the day, and they're in their 25th and 30th and 35th year, and they're performing very, very, very well. I've got $150,000 that'll pay out to my heirs, my beneficiaries, my wife, et cetera, if something happened to me early, if I died, if I graduated, call it what you like. Now you see here, my outlay was fixed. I didn't have a choice of varying this $20,000 up or down. Now I'm going to go to post-Nelson. After I met Nelson Nash and learned how to design a policy to be more efficient, what we said was, you know, the life insurance piece is not really all that important until way down at the end. I mean, you're not going to access the death benefit to this policy but one time, right? And number two, you're not going to access it until you're 70, 80, 90 years old. So let's not focus on it. Let's still create some death benefit, but let's focus on creating some access to cash. In the earlier example, I want to mention we had 2 years where there was no cash value, zero. We put in $40,000 and our cash value was virtually zero. In the model, the way we design it today, of that first 2 years we put in $20,000 a year, we've got $31,000, which is a great advantage over the previous model. And number two, instead of having $150,000 of cash value, we have more. We have a break even. We have more than we put in, and we still have now over $1 million. We started out with less death benefit because we focused on cash value and cash flow and break even. Another important thing I want to mention to you, and you can see here that I've highlighted already, my minimum premium in this policy was not $20,000. I was not stuck paying $20,000 a year. I could vary my payments up and down. Now, hopefully, where they have to bring their premium down to $8,400. So you can see that there's a huge benefit. Now I'm going to how I used it in my personal situation. And many of you know that I have our main company, Alpha Omega Wealth, and then we have subsidiary companies that I personally own and control that do things for me in my life. But in 2003, about a year and a half after I started practicing banking, I pretty much had the gist of it. And I said to my wife, honey, you're a licensee in my corporation. You're an officer in my corporation, and you need a car. And this is kind of the car that she liked. This is a newer car, but in 2003, there was a new Lexus, whatever you call these things. So the first thing I did was I did not charge myself the lowest rate that I could possibly charge. And I'm going to share right here that I borrowed $42,000 from the insurance company against my cash values in my policy. Now, I had to pay the insurance company 5%. I didn't have to pay them principal payments, but I did. I paid them an amortized payment of principal and interest on a 6-year schedule. You can see that right down here, 6 years, 72 months. But I also wanted to show you what my actual schedule looked like, because in addition to paying the insurance company, and you don't have to do this, but you can if you want to have a bank that's profitable. What I did was I told my wife, who trusts me a great deal, I said, I'm going to charge you, honey, 12% on this loan. Now, she looked at me like I had two heads. But this is the loan that we put into effect. We went to the Lexus dealership. We paid $42,000 for the car, and then we made payments for the next 6 years. Now I'm going to show you, first of all, my policy growth, because what I did for the purposes of today's meeting was I stopped the premiums that I was capitalizing into my policy. I stopped funding the policy because the policy had plenty of cash value in it. Now, $20,000 is just a number. You might decide to open up a policy putting 10 times that. You might open up a policy that's a fifth of that. I don't really care about targeting numbers today. I want to show you concepts and how things work. So in my particular case, this was the policy growth during the period of time when we made our car payments faithfully until that car payment was paid off. All we did was borrow $42,000 out and put $42,000 back in, which is a wash. But it means that the $42,000 went back into my system. And we paid the insurance company 5%, and we paid ourselves an extra 7%. So what I'm going to show you here graphically is how that worked. So you remember this, the saver was me, saver was us, and the banker happens to be us, and the borrower happens to be us. So you can see here, I took a $42,000 loan from the insurance company at 5%. We took that loan and we went and bought the car. And Alpha Mega Wealth had to make a payment back to my family bank. It was a 12% loan repay. Just to be clear, this is from my accountant, I do not get a tax deduction at the end of the day for the 12% interest. Alpha Mega gets a tax deduction, but I pick that up on my personal tax return. So that 12% is a wash. Where my tax deduction is in the 5% I'm paying the insurance company. So let's just be clear on those things. But I want to get to the math, because what was important to me is, yeah, I can get the mechanism, but what I really want is I want to know that every dollar is coming back to me. So I've highlighted here situation A. So we have the growth of the policy. The policy came back to me. Don't forget the salvage value of the car at the end of the period. And I also got a tax deduction for the 5% that I paid the insurance company for the money I borrowed, because this was a business expense. At the end of the day, you remember I bought a $42,000 car. At the end of 6 years, my account returned to me $87,000. It's not magic. It's not smoke and mirrors. It's not games with interest rates. These are dollars. And what's so exciting about this whole thing is this is not looking for some pie in the sky volatile return. This is an ordinary life insurance policy designed the right way that returned just barely above 4%. But the difference is we kept track of our expenditures. We were honest bankers. We paid ourselves back the money. And now we know how to get every dollar back on every car we'll ever drive. So the question is, if I can finance a car, if I can take back and recapture debts that I may have had at the bank or credit union or a finance company or a credit card company or a car finance company, if I could finance any debt and figure out a way to recapture the money, control the debt, control the interest, control the taxes, keep the money in a tax-favored and protected vehicle that is a safe savings. And if I can use that in all my companies, so in this case, my borrowers are this list of companies on the right. And these companies will have access to loans because I'm the banker in the middle. And we may have some questions. I'm not sure if we will or not. What I just showed you a minute ago was exactly how I financed the car and exactly where the numbers came from and exactly how I got every dollar back, principal, interest, salvage value, tax deduction, all having that growth accumulate and build up inside my life insurance policy. Now what you see on the screen here is just the general model. So now we can just rinse and repeat. Do we have money that needs to be allocated for something else? If it's college, if it's a second home, if it's a vacation. And I can tell you that in 2012, my wife and I made a trip to Italy, and we spent just under a month there. But before we went, we took a pretty significant loan against our life insurance policies because I wanted to make sure that we could go there without worrying about debt or spending too much. I wanted to make sure because I was putting my wife on an airplane and taking her across the country, across the ocean, that I wanted her to have the privilege and the blessing of flying first class. So we're able to go to 5-star or 5-diamond hotels in Italy, spend almost a month there, go there and come back on first class. And when we came back, we were able to make payments to that private family bank and get all the money back in our account that we had spent. So in a sense, we had the blessing of the trip, and now we had the ability to get all the money back. I never have a meeting of any kind unless we talk about our reading list. And I mean, we have a reading list that'll choke a horse. I know that you see some books behind me that make up a part of our library. And if you're going to embark upon a course of study, which is what this is an advanced course on money. This is a course that you should learn for yourself. This is a course that you should apply to your business ownership. This is a course that you should teach to your kids. And your kids should grow up understanding that using a commercial bank is a luxury that you don't need to use, because if you have a properly funded and properly operating family bank, your children and grandchildren may never need to walk into a bank again. So if you have questions about the reading, I'm happy to answer them. If you have questions about what else we do, I'm happy to answer those. We're going to leave a couple of minutes open for questions. And I'm going to look at my little chat box here.
Yes, and I can open the mics if you would like me to open the mics. Joe, would you like me to open all the mics?
Sure, sure. Okay. If we have any hands that go up, I'm going to just give us a minute. I'd like to give you some of your time back. And I always get excited about doing these meetings. And when I'm done, I always think about the additional things that we could have talked about. I really do love getting in front of a whiteboard, because then I could just go crazy and bring all the concepts out in one place and keep on piling up ideas and strategy.
I put them on mute themselves, please. Because I'm unmuting everyone.
Okay. So yeah, they're all muted.
Yeah, they mute themselves. They can unmute themselves.
Okay. So I have you all so that you could unmute yourself if you want to jump in and ask a question. And if I don't hear any in the next 30 or 60 seconds, then we'll end the call, and thank you for being here with me today.
Okay, just a question coming in. Again, we're just beginners in this, so I'll try to explain it best I can.
Sure.
When you make an investment into the life insurance, independent banking, what is the rate that you're getting on that money?
Sure. I understand your question. I get that question a lot. And one of the first things I want to do, and I thank you for asking, and since you're the first person who asked a question, if you don't already have Nelson's book, we'll send it out to you. So the rate that you'll see when you open up your life insurance policy, it says contract rate 4%. Okay. Now, remember what we talked about earlier about the average 25% rate of return? That could be misleading, right? So you can have a 4% contract rate. It doesn't mean you're going to make 4% on day one. Do you remember, without me having to go backwards to that graph, do you remember when I showed you the chart of the life insurance policy and I said, this is how I was modeling policies pre-Nelson, and this is how I was modeling policies post-Nelson? You remember that piece?
Yes.
Okay. So in a post-Nelson environment, at the end of 10 years, after putting in $20,000 a year for 10 years, I put in $200,000 and I had $215,000. Yeah, I have a contract rate, but that contract rate is going to be over a lifetime. And between the expenses that you see in the policy and the dividends over a lifetime, you're going to net, and I say net, over 4% in your policy. That's pretty modest. But remember, we're not comparing a life insurance policy, which is a safe savings, to an investment. We're comparing a life insurance policy to a savings account, which pays almost nothing. So in the first 10 years, what's your rate of return? If you're breaking even, it's 0. When you look at what your policy returns in the second 10 years, it's going to be more dynamic. It's going to be closer to that 4%, because now your policy is catching up. And the longer you have that policy, the better it gets. Now, what I'll share with you as we go forward and you read that's on a one-on-one, is that Nelson taught us it's not about the rate of return, it's about the volume of return. So, what we pay our bills with, checks that we write out of our checking account, and we write those checks on cash balances that we have in some account. Virtually every life insurance policy that we design is a whole life policy. We don't use universal life. We don't use variable life. We don't use adjustable life. We don't use index universal life, which are the popular policies, which I think are doing terrible. We use a life insurance policy that's a whole life policy, not on death benefit, never. Have not missed paying a dividend for the past 100 years. So between the contract rate, 100 years worth of dividends, net performance of the company, you'll be above 4. We don't know how much above 4, but you'll be able to wipe out all the debt in your life and create generational wealth that your kids can then build on top of that. Hope that helps.
Yes.
Thanks for that. We have another question going once.
Hey, Joe, I had sent a note through the chat, but is there a way to roll a 401k into a life insurance policy?
Oh, man, I wish there was. I've had that's one of the most popular questions that we've gotten over the past several months. So yeah, you can roll a 401k into an IRA. You could roll it into a Roth IRA, which requires some expense and some tax. If you're over 59 and a half, you can roll it into an IRA and then take withdrawals from your IRA because you're over 59 and a half and you no longer have penalties. And you can start paying the tax and then putting some of the money in the life insurance. But no, you can't roll it directly without a tax hit from a 401k or any tax-favored, tax-deferred vehicle into life insurance. Now think about this. A life insurance policy, the way we design them, are all paid with after-tax dollars. So you're going to pay the tax on the money before you pay the premium. So you're paying the tax on the small amount. And then as your policy grows over decades, you're going to accumulate, hopefully, hundreds of thousands and millions of dollars. And that big pile of dollars is going to be tax-free. So a life insurance policy basically works the exact opposite of the way an IRA or 401k works, because with IRA 401k, you're taking a tax deduction on the small amount going in, and then you're going to take a tax hit on the entire nest egg in retirement, which is probably the worst time in the world to start paying bigger taxes. So it works the exact opposite. So sorry you can't roll it over. I would love to take that order from you. We can help you design. There are ways that you can take money without a tax hit from your 401k before the age of 59 and a half. But those rules are very precise, and we have to follow them very carefully, because we're dealing with the IRS and the Department of Labor and ERISA. So we don't want to violate rules. We don't want you to have unseen tax penalties and unseen taxes, and we want to do everything transparently.
Thank you. Would you also mind putting up the slide on the references again?
The books?
Yes, please.
Sure. So one book that's not on there is Kiyosaki's Second Chance. I think that's one of the best books on finance I've ever read. And I don't sell real estate, but Kiyosaki has a really good handle on addressing what is an asset, what is cash flow, what is a liability, what's the difference between a saver and an investor. Why are savers losers? That's his quote, not mine. Take their money and put it in a savings account where they're going to be taxed. Their investors and rich people go to the bank and they borrow that money that those savers leave with the bank at the most efficient tax cost that they could possibly get, which is tax deductible, because you can deduct the interest you pay on borrowed money for real estate investment, right? And then they use those loans to build up capital assets, i.e. Cash flowing real estate. And they use the cash flow from that real estate to buy their sports cars and their vacations and their weekends away and their toys and their buy their liabilities. So how are we doing on questions? Do we have any more? Okay, we're going to close it up, and I appreciate everyone being here. We're going to continue to have webinars periodically. I believe we're going to have one. I know we're going to have one for sure in October. I'm sure we're going to have one either the end of August or beginning of September. So if you have questions that you didn't get to ask today, you didn't think about until tomorrow, write to them, write on the voicemail. We are continuing to, the recording of this meeting will be on the website to clean up some of the glitches that occurred during today's talk. If we can go back over and fix some of those, we will. Errors and mistakes, and we're going to do the best we can to serve you. So talk to you and thanks for being on today.